single-family starts month-to-month dropped 10%.
What do you want the Fed to do?
We just don't really know.
Definite doom and gloom.
Being a fundamental undersupply of housing within this country.
We're not even thinking about tightening, but it hasn't said we're not thinking about loosening.
Welcome back to Housing Headlines with Chris. The housing market is officially cooling down. The number of new houses hitting the market currently versus this time last year is down by 6% and has now actually declined for 3 weeks in a row. Realtor.com reports that while the median home price nationwide has increased to $450,000, 15% of home sellers actually cut prices in June. So not only less homes being listed for sale, fewer are actually selling. Sales of existing homes fell 14.2% in June and has now receded for 12 straight months. So where do we go from here? I'm so glad you asked. So there's a lot of uncertainty, and while nothing is impossible, a full-on or even moderate housing crash is incredibly unlikely. Houses would have to not only start losing significant value across the board, but they would have to lose the 20% or more just to get back to the levels that they were 2 to 3 years ago. That's wildly unlikely. And even if it happened, it would not constitute a crash. It would be more of an overcorrection, a transitory overcorrection, if you will. In fact, the US is an estimated 3.8 million homes short of the number of homes Americans actually need. So fewer homes are being sold, and we're already millions short of where we should be. We need a combination of more people finally deciding to sell their homes, as well as builders to increase the pace of new home builds in order for a housing crash to even be mathematically viable. So that's my opinion. Look at it from the perspective of someone who has maybe wanted to sell their home, though it hasn't been in any rush. They've seen price increases over the last couple of years, which they like, as that means they have more value and can make more money. But they see how it's hard to find a new home to buy, and they haven't quite decided to jump into the market and sell yet. Now they're starting to see some price cuts and maybe begin to worry. But price cuts are totally normal in a balanced market. If our potential home seller expects housing demand to fall, which may cause their house to sit on the market longer, they may become less likely to list in the first place. Nearly a fifth of homeowners surveyed by Zillow earlier this year with no plans to sell cited financial uncertainty as a reason. And with 71% of sellers buying at the same time and likely facing a much higher interest rate than the one they currently have, the idea of trading up or even downsizing is much less appealing. It might be more expensive. On the flip side, we must talk about builders. They are scared as well of this chatter of housing crash and the apparent reduction of buyers in the market. But really, I can't blame them. Builders took massive losses after 2008 when they had empty houses sitting during a legitimate housing crash. In June, there was a 31% reduction in the sale of new homes compared to the same time last year. This is projected to fall this month as well. Realtor.com anticipates fewer homes being built over the next 12 months as builders don't want to put up the money to construct homes if they're not confident they can actually sell. They say that 87% of builders are now planning to slow down their pace of construction. There's nonetheless a housing shortage, right? Buyers have to buy, right? Well, to some degree, yes. But multifamily and mixed-use complexes are keeping younger renters signing as mortgage rates climb, and the houses that are for sale aren't of the variety or cost that actually allows for purchasing what they want or for purchasing the dream home they always were told they deserve. Renters, and everyone for that matter, continue to fight climbing costs as well. Inflation is what we're talking about here. Inflation is most closely measured by the Consumer Price Index, a monthly publication by the U.S. Bureau of Labor Statistics. Essentially, it measures how much prices are increasing on standard things American consumers buy. In June, this raised to a 40-year high. It actually went down this month more than anticipated, which did allow for a slight ease in mortgage rates and, more importantly, our personal budgets. But it's far from enough to fix things, and it'll take several more months of similar momentum before the financial uncertainty aspect fades from the minds of would-be first-time homebuyers and other renters choosing not to dive into the buyer side of the real estate market. This all feeds back into the housing shortage. It makes selling look less appealing for homeowners, it makes buying look less appealing to renters, and it makes building look less appealing to builders. What's going to give? We'll all find out together over the next few months. In other economic news, the unemployment rate hit 3.5%, a very low figure, and that is a positive sign. Wage growth beat estimates as well, with American labor seeing a 5.2 increase in hourly pay from this time last year. Not enough to keep up with that 8%, 8.5% inflation, but definitely in the right direction nonetheless. So our nation bank, the Federal Reserve, raised the rates at which they make loans to major banks both in June and July. The next time they meet will be in September. CNBC reports that financial experts in general are predicting a third rate hike of 0.75%. This rise in rates affects consumer rates on everything from mortgages to credit cards. The Fed has raised benchmark interest rates 4 times this year for a total of 2.25 percentage points. That has brought the Fed funds rate to its highest level since December 2018. Now we turn to special correspondent Alex Hess with a report on a very serious and underreported consumer credit fiasco. Alex?
Thank you, Chris. Here in the Consumer Corner today, we're covering some potentially frightening news from Equifax. One of the 3 major credit bureaus is back in hot water for a coding error on their credit algorithm. As many homebuyers learn, credit can be one of the largest obstacles in their mission of obtaining their next property. A credit score decrease of just 10 points can cost someone thousands of dollars in interest payments. Equifax has been aware since April of 2022 that they issued inaccurate credit. How inaccurate were the scores? It's reported that some loan applicants were issued scores possibly more than 25 points lower than the score should have been. Equifax has yet to disclose whether the error was miscalculating late payments, collections, or any other combination of credit factors, but they have certainly affected the lives of millions. As of now, only an estimated 300,000 consumers have been contacted of being affected by the coding error, but there's assumed to be more that have yet to notice or report. Any line of credit opened, whether it was an auto loan, credit card, personal loan, business loan, or mortgage, could have been affected. Equifax has stated that the variation in credit scores could have either decreased or increased a consumer's credit score. For some home buyers, they got very lucky, and for some, they could possibly now stuck be paying thousands more to their lender by no fault of their own. It is unclear whether the course of action to be taken in mass, but if you purchase a property between March and April of 2022, it is wise to contact your lender immediately because you could be paying more than you should. Lenders are now forced to consider how to handle this retroactively. Do lenders now just increase their rates on those that have artificially elevated scores? Do they retroactively deny the mortgages or loan holders for those that were approved when they shouldn't have been? Do they charge premiums for investors? Will these loans even be insurable on the second mortgage market? So much is to be determined as the months come forward, and to find out more, stay tuned to Shoemaker Mortgage News.
Zooming into a bit more local news, Dallas City Manager T.C. Broadnax proposed a property tax cut of 2.75% as a part of the city's annual budget. Dallas Mayor Eric Johnson said in a statement, "I have been unequivocal that the top 2 priorities for this year's budget should be public safety and tax relief for our city's homeowners, renters, and businesses." Fox 4 reports, though, that it's likely homebuyers will still end up paying more than last year because of a rise in home values overall. Last year, the average single-family home in Dallas was valued at $335,000. Now the average is about $75,000 higher. DFW ABC affiliate WFAA outlined some interesting statistics showing just how much this financial uncertainty is affecting the North Texas market. Home showings across Dallas-Fort Worth dropped 30% in June from June 2020. Showings in North Texas did fall faster than the national rate, that 30% North Texas compared to an 18.7% average national. On a month-to-month basis, though, June showings fell 18% from May. So it fell 30% since last year, fell 18% from May. And even though the rate fell faster in DFW than across the country, the number of tours that each house get actually exceeded the national average. In fact, DFW homes averaged 9.2 showings in June compared to 5.6 in the national average home. Despite all this, due simply to the housing shortage, prices are expected to keep rising overall, just more slowly than the last 2 years. Home prices in Collin and Denton counties have increased the most over the past year, with Collins County still having the highest median price at almost $550,000. Okay, the best for last, mortgage rate. So mortgage rates have remained relatively calm over the last couple of weeks, though not, of course, without some small fluctuations. But larger changes in rates are still possible as investors try to predict the likelihood of a coming recession. NerdWallet right, 3 facts that are correct at the same time. 1, inflation is easing. 2, the inflation rate is still far too high. And 3, the Federal Reserve will most likely raise rates by a lot next month. In such an environment, mortgage rates would trend upwards, with an occasional brief downward squiggle. Inflation tends to cause mortgage rates to rise, while a recession usually sends them low. Most of the recent volatility in mortgage rates is due to investors waffling between worries about inflation and a recession. Last week's job numbers gave a boost to the sentiment that a recession is not imminent. Bankrate.com, which puts out a weekly mortgage rate trend index, found that experts are mixed on where rates are headed. 43% say rates will go down, 29% say that they will go, and 29% say they're going to stay about the same. Thank you so much for watching. We'll see you next month.